On December 11, 2008, a seemingly impenetrable fortress of financial brilliance collapsed overnight, exposing a crater of devastation that stretched across the globe. For decades, the 17th floor of the Lipstick Building in Manhattan operated as a black box of impossible consistency, churning out steady, positive returns regardless of how violently the stock market swung. Thousands of individuals, hundreds of charities, and dozens of international banks believed their money was safe, insulated by the genius of a former NASDAQ chairman. But investigating this supposed financial miracle revealed a staggering truth. There was no trading, there was no genius, there was only a $64.8 billion void. This was not a complex, highly calibrated investment strategy. It was a simple, brutal deception that fooled the world's most sophisticated financial minds, leaving shattered lives and empty accounts in its wake. At the heart of this devastation was a Ponzi scheme, a specific type of investment fraud that pays existing investors with funds collected from new investors. The organizers of these schemes often promise to invest your money and generate high returns with little or no risk. But in reality, the fraudsters do not invest the capital at all. They simply shuffle funds from new entrants to satisfy the withdrawal requests of earlier participants, skimming a lavish lifestyle off the top. The architecture requires a constant, accelerating influx of new capital to survive. The moment the flow of new money stops, or too many investors ask for their money back at once, the entire structure disintegrates. Understanding how Bernie Madoff operated the largest iteration of this fraud in history requires dismantling the very concept of financial trust. The architect of this unprecedented financial disaster built his empire not through aggressive marketing, but through the strategic cultivation of an untouchable reputation. Bernie Madoff did not chase investors. Instead, he engineered a psychological environment where investors chased him, desperate to be granted access to his exclusive inner circle. By positioning himself as a pioneer of electronic trading and a pillar of the Wall Street establishment, he created a halo effect that blinded even seasoned analysts. He served on regulatory advisory committees and mingled with the financial elite, wrapping his operations in an aura of unassailable legitimacy. This carefully constructed persona was his primary weapon. It allowed him to bypass the rigorous scrutiny normally applied to hedge fund managers, because questioning someone of his stature was considered not just impolite, but financially foolish. To ensnare his victims, the perpetrator weaponized a phenomenon known as affinity fraud, a tactic that targets members of identifiable groups, such as religious or ethnic communities, the elderly, or professional networks. Fraudsters who use this method often are, or pretend to be, members of the group they are targeting, exploiting the inherent trust that exists within these tight-knit circles. Madoff ruthlessly deployed this strategy within wealthy Jewish communities and exclusive country clubs across the United States. He understood that a recommendation from a trusted friend on a golf course carried far more weight than a glossy prospectus. Members of these communities assumed that if their peers, whom they considered smart and successful, had vetted the investment, it must be safe. This outsourced due diligence created a catastrophic chain reaction of misplaced faith. The mechanical execution of the deception relied on a fabricated investment strategy known as the split strike conversion. Investors were told their money was being used to buy a basket of blue-chip stocks, while simultaneously purchasing put options and selling call options to minimize risk and create a collar around the returns. It sounded sophisticated, mathematically sound, and incredibly safe. The strategy was designed to produce steady returns of 10 to 12% annually, a yield that was attractive but not so absurdly high as to immediately trigger alarm bells. By avoiding the temptation to promise astronomical, overnight riches, the illusion maintained its credibility. The steady, predictable numbers acted as a sedative to the investor's critical faculties, lulling them into a false sense of security that lasted for decades. For the individuals caught in this web, the psychological grip was absolute. Investors received pristine paper statements in the mail every month, detailing trades that had never actually occurred, complete with precise timestamps and pricing data. These fabricated documents served as tangible proof of their growing wealth. People planned their retirements, funded their grandchildren's educations, and built philanthropic legacies based on these phantom numbers. The fear of missing out on such reliable returns was matched only by the fear of being expelled from the fund. Madoff frequently threatened to return the capital of anyone who asked too many questions, a manipulative tactic that swiftly silenced curiosity. The victims were effectively trained to remain passive and compliant, willingly surrendering their financial autonomy to a man they believed was a benevolent genius. The The contagion eventually spread far beyond individual country club members, infecting the global financial system through the proliferation of feeder funds. These were massive investment pools, managed by supposedly rigorous financial institutions that did nothing but funnel billions of dollars directly into the 17th floor operation. The managers of these feeder funds collected hundreds of millions of dollars in fees for essentially acting as a conduit for the fraud. Their involvement provided a secondary layer of false legitimacy. When European banks and international pension funds saw that prominent asset management firms were heavily invested, they assumed deep institutional due diligence had been performed. In reality, the feeder funds were willfully blind, ignoring glaring red flags because the consistent returns and the massive fee structures were simply too lucrative to question. Despite the impenetrable facade, the mathematical impossibilities of the returns were visible to those who knew where to look, leading to severe SEC failures over a span of 10 years. Independent financial analyst Harry Markopolos repeatedly handed the Securities and Exchange Commission a roadmap of the fraud, submitting detailed reports in 2000, 2001, and 2005, proving that the split-strike conversion strategy could not possibly generate the reported returns. He pointed out that the options market was not large enough to support the volume of trades supposedly being executed. He demonstrated that the returns did not correlate with any known market conditions. Yet, the regulatory body repeatedly failed to connect the dots. The investigations were superficial, often conducted by junior staff members who lacked the market experience to comprehend the complex derivatives being discussed, allowing the deception to continue unchecked. This regulatory blindness exposed a terrifying flaw in the oversight of the financial markets. The investigators treated the perpetrator as a respected colleague rather than a potential suspect. During interviews, they accepted his vague explanations and his manufactured trade tickets without taking the fundamental step of independently verifying the transactions with the central clearing houses. Had any investigator made a single phone call to the depository trust company to confirm the existence of the purported stock holdings, the entire billion-dollar lie would have instantly unraveled. Instead, the assumption of compliance shielded the operation from basic auditing practices. The failure was not merely an oversight, it was a systemic collapse of professional skepticism, demonstrating how an aura of authority can paralyze the very institutions designed to protect the public. Inside the operation, the mechanics of the illusion were shockingly primitive, relying on antiquated technology to manufacture the massive paper trail. While the legitimate brokerage business operated on modern trading platforms on the 19th floor, the fraudulent advisory business was run on an old IBM server 2 floors below, utilizing dot matrix printers to churn out the fake trade confirmations. A small, fiercely loyal staff worked in an isolated environment, manually inputting historical stock prices to ensure the fabricated trades always appeared profitable. When auditors did arrive, this staff would scramble to print new, backdated documents, literally cooling the freshly printed pages in a refrigerator before handing them over to make them appear older. It was a chaotic, manual process of deception, hidden behind closed doors and protected by compartmentalization. The sheer longevity of the operation defied all historical precedents for financial fraud. Most deceptive schemes of this nature collapse within a few years because the exponential math required to sustain them becomes impossible to manage. But by keeping the promised returns relatively modest, limiting access to create artificial scarcity, and leveraging the massive influx of capital from international feeder funds, the illusion survived multiple market downturns, including the burst of the dot-com bubble. Each time the market crashed and this specific fund remained steady, the perpetrator's reputation as a financial wizard grew stronger, paradoxically drawing in even more capital during times of economic distress. The operation became a self-fulfilling prophecy, sustained by the collective delusion of a financial community desperate for a safe harbor. The catalyst that finally shattered the illusion was an external force too massive to manipulate, arriving in the form of the 2008 financial crisis. As global markets collapsed, liquidity dried up, and panic swept through the financial sector, investors everywhere desperately needed cash. The steady, reliable fund that had served as a safe harbor for decades suddenly became the primary source of liquidity for thousands of distressed clients. The mathematical reality of the structure finally asserted itself. The operation required new money to pay off exiting investors, but the global credit freeze meant no new capital was coming in. The delicate balance of the fraud was violently disrupted, setting off a chain reaction that no amount of psychological manipulation or fabricated paperwork could stop. In the final months of 2008, the operation faced an unprecedented run on the bank. Redemption requests poured in, totaling an insurmountable $7 billion. The perpetrator desperately scrambled to secure emergency funding, reaching out to his wealthiest clients and closest associates, attempting to raise capital under the guise of a special, highly exclusive new investment opportunity. But the macroeconomic environment was too severe. The well had run dry. The account balances, which investors believed held billions in blue-chip equities and treasury bills, were practically empty. The money had long since been paid out to earlier investors or siphoned off to fund the lavish lifestyles of the inner circle. The physical reality of the empty bank accounts finally collided with the decades-long fiction. The inevitable confession arrived not in a courtroom, but in a quiet Manhattan apartment. On December 10, 2008, cornered by the undeniable math and the crushing weight of the redemption requests, the architect of the fraud admitted the truth to his sons. He told them that the entire investment advisory business was a fraud, describing it as one big lie. The sons, who held senior roles in the legitimate side of the brokerage firm, immediately reported the confession to federal authorities. The following morning, the FBI arrived at the apartment, bringing an abrupt end to the longest-running and most destructive financial deception in history. The arrest sent shockwaves through the global economy, instantly vaporizing the life savings of thousands and exposing the catastrophic failure of the regulatory system. The immediate aftermath was a landscape of profound human tragedy and institutional ruin. As the reality of the deception set in, the true cost of the fraud became agonizingly clear. Elderly investors who thought they were financially secure were forced to sell their homes and return to work. Prominent charitable foundations, having entrusted their entire endowments to the supposed financial genius, were forced to close their doors, halting vital medical research and community services. The betrayal was absolute, severing decades-long friendships and fracturing families. The psychological trauma of discovering that one's entire financial reality was a carefully constructed mirage drove several individuals to suicide. The damage extended far beyond the balance sheets, leaving a legacy of shattered trust and profound emotional devastation that no financial recovery could ever fully heal. The fallout triggered a monumental legal and forensic reckoning as investigators sifted through decades of fabricated records to untangle the massive web of deceit. The court-appointed trustee, Irving Picard, launched a relentless, years-long campaign to recover stolen funds, pursuing the feeder funds, the willful enablers, and the early investors who had withdrawn more money than they had deposited. This process, known as a clawback, was legally necessary but emotionally agonizing, as individuals who believed they had legitimately profited were forced to return funds to compensate the ultimate victims. The recovery effort exposed the deep complicity of major financial institutions that had ignored the glaring anomalies in exchange for lucrative fees, resulting in billions of dollars in settlements and fundamentally altering the legal landscape of institutional liability. The enduring legacy of this catastrophic event is a stark warning about the inherent dangers of outsourced due diligence and the seductive power of exclusivity. Financial experts advise that investors must fundamentally shift their approach to wealth management, replacing blind faith with rigorous, independent verification. Transparency must be the non-negotiable baseline of any financial relationship. If an investment strategy cannot be clearly explained, or if the custodian of the assets is not an independent third party, the risk of deception is unacceptably high. The assumption that regulatory bodies or sophisticated institutions have thoroughly vetted an opportunity is a dangerous fallacy. True financial security requires an active, skeptical engagement with the mechanics of where your money is held and exactly how it is generating returns. Protecting oneself from complex deception requires understanding that fraudsters do not target intelligence. They target human psychology. They exploit the desire for safety, the fear of missing out, and the deep-seated instinct to trust those within our own communities. By recognizing these psychological levers, individuals can build a mental firewall against manipulation. The billion-dollar lie worked because it offered a comforting illusion in a chaotic world. It failed because reality, no matter how long it is suppressed, eventually demands an accounting. Let this history serve as an empowering call for relentless vigilance. Question the unquestionable. Demand verifiable proof over prestigious reputations. And remember that in the realm of finance, the promise of a risk-free return is often the most dangerous risk of all.